Hello learners, welcome to our session today. I am your instructor CPA Ringo Frederick. Recall in our previous class when we introduced the concept of sensitivity analysis, we said that we'll be looking at two approaches. And these approaches, basically, if you can recall, we talked of number one, break-even point analysis, break-even point analysis approach. And number two, we talked of the impact analysis approach. Impact analysis approach. These are the two approaches that we said we will be talking of anytime we are handling sensitivity analysis. By now, you must be very good in break-even point analysis, because that is what we have been looking at in our previous sessions under sensitivity. And we clearly stated that at break-even point analysis, you'll find that at this point, it will always be upon us as financial consultants, basically, to equate our NPV to be equal to 0. And in this case, you're going to equate our NPV to be 0, or rather at a point whereby our NPV is 0. So in this case, I'm going to conduct an analysis under each and every financial variable that I'll be having to see what will be the change or the maximum tolerable change that we can accept, so that we should not go beyond our NPV to be 0. So we must always maintain at least 0 and above. So whatever that we are looking at under break-even point, ideally, we were targeting, or our task was to, at least at this point, to achieve that tolerable change that you cannot go beyond. The tolerable change that you cannot go beyond. That was about what we had talked about break-even point analysis. But at this point, when we are talking of break-even analysis, in this point we are talking about impact analysis. Impact analysis is quite different, and these are what I want us to learn today under impact analysis. So first of all, I'm going to give you the concept behind impact analysis, so that once when we have a problem to solve with impact analysis, things will be very easy on our end. So under impact analysis, in this case, my good students, we are given a percentage that these variables will change with. Recall, break-even, we were the one to determine the tolerable change. But under impact analysis, in this case, I will be given an adverse percentage change of our variables. So our task will be to basically measure the impact of this change to our resultant or original NPV. It will be upon us to measure basically this change, right? It will be upon us to measure what will be the impact of this adverse change to our resultant NPV, so that at this point, I'll be looking at each and every variable in isolation, so that this will clearly tell us which variable, the variable that I'm having, and the impact that it is having in our NPV. So that in this event, of course, the variable that will be having the highest negative impact, that is the one that we should always tend to avoid. So this is impact analysis. So introducing you guys to impact analysis, my good students, it is important for us to know that this approach shows percentage change in NPV. This approach shows the percentage change in NPV. This approach shows the percentage change in NPV, percentage change in NPV, or IRR, or IRR, or IRR. Recall the concept of IRR, I stated it earlier on, or IRR, as a result of a given change, as a result of a given change, as a result of a given change in the project variable, variable, in the project variable, in the project variable. So these are what I want us to understand and agree, that under impact analysis, my good students, our task will be to see the impact of this percentage that you're given to changes in our NPV. Recall break even, you are looking at the change under each variable, right? The tolerable change under each variable. But our focus on impact analysis, our focus will be on NPV. Our focus will be on NPV. That is the most important item for us to basically consider. So once we have this case and once we have this knowledge, which I believe all of us we've dissected, the other key element that probably Mwalimu will also want to share with us before we look at a question is the question that majority of us probably have been asking, and break-even point that you'll find that impact analysis will basically seek to answer that question, that what is the percentage change in NPV or IRR that will arise as a result of a given change in the key variable. This is what impact analysis will be answering. So in this case, let us jump to a question here. I want us to go through this question of ours together. Remember, some of these questions basically are from your past papers. Like this one was attested, I think, back in 2013, but you can just check it out. Still, I'm going to attach this question so that you can have it clear. Excuse. So that is a question that I'm given, and I believe it is visible to all of us. You can take a screenshot of the same. So let's go through this question. These are what you're told, that R Limited is considering a project with the following cash flows. I'm given our cash flows. In this case, I'm having year 0, 1, and 2. I'm given a cost of plant, running cost, and I'm having savings as well. So R Limited cost of capital is 9%. That is what the examiner has given us. So we are required here to basically, 1, determine the sensitivity of the project to changes in the level of costs of plant, running cost, and savings, considering each factor at a time. Of course, that is in isolation, and assuming each factor is varied adversely by 10%. So ideally here, our good examiner is telling us that I'm having an adverse change of 10% on each of the variable that you're asked to compute. So we are also required to comment on the factor which is most sensitive to adverse variation, right? So you need to determine that factor that is most sensitive, that will have a huge impact probably if at all it is adversely changed. So these are what you're having. So having this case, I can squeeze this question for us to have it somewhere here below here. Yeah, we can have it just below there, which I believe is still visible. So at this point, my good students, our task here is to basically come or determine our NPV. That should be your first step. We need first of all to determine our NPV. After we have determined our NPV, then I can be able to basically determine the aspect of the impact of the change that I'll be having based on each variable that I am given. So again, it is at this point that you should always recall how to work out our NPV, my good students, which I'll not be tired of repeating it again and again. Recall, like we said, anytime when we are talking of NPV, basically, we should always have this in mind. We should always tend to have our NPV, right, to be equal to our present value of cash inflows, minus our initial outlay, This is what will give us our NPV, and I'll not stop repeating that. I'll always repeat till you guys get it very clearly. So present value will depend. Present value will depend with what? In determination of the present value of cash flows will depend with the following. If our cash flows are regular, the factor that we are going to use what present value interest factor, annuity. If our present value, in this case, if our cash flows basically are irregular, therefore my factor that I'm going to use should be present value interest factor. Recall how to work out present value interest factor annuity given the rate and number of years. We should always be talking of 1 into 1 plus r raised to power negative n divided by r. Whereas present value interest factor, I should be having, of course, 1 plus r raised to power negative n. These are some of the main items that you must always tend to have in mind. Regular cash flows are simply aspect of us, we are receiving same amount over a period of time, right? Whereas irregular cash flows, you'll find that these cash flows basically are not the same. They vary. This year I'm getting this, next year I'm getting the other one, right? And at this point, for us to determine our cash flows, recall the present value, you said it will depend, of which you've looked at it there. Then our cash flows, basically, we should always tend to take, of course, the revenue that we are having or savings that I'll be having minus our operation cost, or rather operating costs, right? So in this case, that should give us our cash flows, and it will also depend, in this case, in the event that we are having, of course, the concept of depreciation tax shield, or when we were charging depreciation. In this case, of course, you're going to less tax. Then in all this, we'll be adding what? Depreciation tax shield. Depreciation tax shield. Very important item that you must always tend to have. That should give us our annual net after tax cash inflows, which again, I had looked at this in our previous class. So once we have these basics in our mind, you'll find that handling any question for in determination of NPV, things will always be very, very easy on our end, right? I want us to be up to that point. I believe we are on the same page, yeah? So looking at that point, let us dive to the question, which we have looked at it. So diving to this question, it is upon us to identify if we are dealing with regular cash flows or irregular cash flows. This will enable us basically to determine or to basically consider which PV, which factor we are going to use, if it is annuity or if it is for lump sum, right? In our case, my good student, if you can check our cash flows, basically year 1, year 2, they are not the same, or we won't be achieving the same, because they are, I'm having running cost of 4,000 in year 1 and running cost of 5,000 in year 2, whereas savings, which in this context is like our, which in this context basically is like our revenue, which is also different. So that is to say, I'm having what? Irregular cash flows, right? So what will be required to do here after we have this in mind, therefore I will be required to prepare that cash flow statement here, not statement per se, but the movement of what I'll be expected to have, where in this case I'm having our period, right? 0, 1, 2. What will be our cash flows here? Our cash flows and present value interest factor, given our rate. In this case, our rate, our good examiner had given us what? 9%, right? Then I should be having our PVs here. So we start with cash flow in period 0, because our first procedure, my good student, that we must have is we must determine first of all our original NPV. Actually, that should be your first step. Determine, anytime you're using impact analysis, the first thing that you need to determine is to determine what? Excuse me, your original NPV. Determine your original NPV, and that is what we want to determine here, our original NPV. This is basically determination of our original NPV. Original, okay? Original NPV. That is what you want to determine. So, year 0, our cash flow is outflow. an outflow of how much? Our investment here, we are told we are having a cost of the plant, which is what? 10 million. So I'll be having minus 10. Our figures are in thousands, right? What is the present value interest factor? 9%, year 0. This one, whichever rate that you're using, year 0 will always give us what? Will always give us 1. And you can prove that here. We can prove that here. If we were to prove that one, this is irregular, right? So being irregular, look at this case, I'm having 1 plus 0.09 raised to power negative 0. What will you be having? That is 1.09 raised to power negative 0. I want us to do it together so that you guys should understand. If you can check it out, you'll find that it is giving us 1. And therefore, our present value with our initial outlay, I'll be having what? Negative 10. I'll be having negative 10, which in that case is what I'm having there. Come to the first year. What will be our cash inflow in the first year? The cash inflow in our first year, my good students, what was our saving in the first year? Our saving in the first year, we had 12 million, right? So in this case, whatever that you want to do is to determine our cash flows in these years. So year 1, we can see that our saving is 12 million. What about our cost? Because you're talking of initial we are talking of basically what you had written there. Cash flows, basically we are talking of what? Our revenue minus our operation cost. So 12 million minus our operating cost here, which is 4 million. That should give us our cash flow of how much, my good student? This should give us 8 million. So confidently, I'll be having 8 million there. Then year 2, what will you be having in year 2? In year 2, my good students, I'm having a savings of 14,000, whereas our basically our cost is 5,000. So in that case, you can clearly see 14 minus 5 is giving us what? 9,000. So that will be our cash flows in that respective years that you're having. So once we have achieved that, let us come and determine our present value interest factor. Present value interest factor year 1, 9%, what will you be having? I'm taking 1.09 because ideally here it is 1 plus 0.09, that is percent, raised to power negative 1, which in this case I'm having 0.9174, right? To determine for year 2, I'll just take it simple. I'll take my answer here, divide by 1.1, which in this case should give us 0.8340. I know you wonder, Mwalimu, why have you go that fast? Remember that that's a shortcut that you can always work it out, or better still, you can prove it. Take your formula again. You just have 1.09 raised to power negative 2. In this case, we'll be getting how much? Basically, in this case, we're talking of, that is a negative, this is negative 2. I'd used a different rate. So basically, this is talk of I'd use 0.01 instead of 0.09. So this case, you're having 1. I want us to work it out together to see the shortcut of Mwalimu. Then you go the long route, right? So here, we are having the first case we've determined, the first here, which is 1 plus 0.09. Mwalimu will take us slow. Raised to power negative 1 to give us 0.9174, right? So I divide by our 1 plus r. So 1 plus r is 1.09, which in this case is giving us what? 0.84, 0.8417. Better still, you can use the long route by taking 1 plus 0.09 raised power negative 2. You'll find that it is giving us the same thing, 0.8417. So when you're having several years, the best way that you can always work it out, once you've determined for year one, once you've determined your present value, or rather your factor for year one, what you need to do, you can always divide respective years by 1.1. The answer that you get in year 2, you divide by 1 plus r. The other year, you divide by 1 plus r. It is just the same as what you are doing here, right? So once we have that in mind, therefore my cash flows in year 1, present value of the cash flows, I should be having 8,000 by 0.9174, which in this case should give us 7,339.2. The other should give us 9,000 times 0.8417. This should give us 75.3. So what will be our NPV here? My NPV here, I'll be having minus 10. That is, of course, minus 10 plus 7,339.2 plus 7,575.3 to give us our NPV of 4914.5. This will be our NPV. That will be our NPV. Believing that we are all on the same page, guys, that will be our NPV. I want to show you all the tricks on how you can always tend to work it out, right? I want to show you all the tricks that you can always tend to work it out. So once we have determined our NPV, you'll find that there is other student who will do like this, which should be correct, by the way. This other student will have taken our NPV here to be equal to, now just working it directly, you could have taken your initial outlay, which is negative 10,000, plus, or maybe let us work it out in this case. Our present value, you could have taken it like you take, of course, your 8,000 after determining your cash flows, right, times 0.9174, which is more the same actually, plus 9,000 times 0.8417, then minus 10,000. You'll find that it will be exactly the same as what we've determined there. So it doesn't, as long as you know what you're doing, you can use so many routes, right? You can use so many routes. So basically, this is our NPV that we've determined. That will be our first step. Remember, our question was not determining our NPV, but rather the question here, we were asked to work out our sensitivity analysis. So we were told that we should work out our sensitivity sensitivity analysis with an adverse effect of what? Adverse effect of 10%. Adverse effect of 10%. Adverse effect of 10%. That is what the examiner wanted us to do. Adverse effect of 10%. So how will we go about it? At this point, you'll find that it will be simple. We start with our first variable, my good students. Let me have this question with us clearly so that you can check it out. Let us start with this. Because here we are told that, I'm increasing the question. Determine the sensitivity of the project to changes in the levels of cost of plant, running cost, and savings. So in this case, I want to consider, we start with what? We start with the cost of the plant. Cost of the plant, cost of the plant, cost of the plant. So starting with the cost of the plant, what will we be having? Starting with the cost of the plant, that is what I want to do to start with. So sensitivity analysis here, sensitivity analysis here. The first one you're doing, we are starting with cost of the plant, cost of the plant, cost of the plant, cost of the plant. Sensitivity analysis. Adverse effect is on the cost of the plant. Allow me just to remove this question because we have everything. So sensitivity analysis here, based on the cost of the plant. Remember, adversely affected by 10%. So what will be the adverse effect? In this case, all our factors remaining constant. That is what should click at the back of our mind. All our factors remaining constant. All our factors remaining constant. So the adverse effect here will be, you'll find that my cost will increase because you're talking of adverse cost. Ideally, in this case, it will increase. Reduction of cost is positive or favorable, whereas when you're talking of increase of cost, increase of expense is adverse. So initially, this was our original cost. Initially, this was our original cost. So if we adversely affect it, what will we be having? I should be having 10,000 times being adversely affected, so it will increase by 1.1. This should give us, because this is 10%, so I'm having 10,000 times 1.1, which will give us what? 11,000, which will give us 11,000, which will give us 11,000. Better still, you can take 10%, you can take 10% of 10,000, then you add on your original cost, just the same as you're talking of whatever figure that I'm having times 1.1, which you're having it there. So once you have this in mind, my good students, in this case, all these factors remain constant. All these factors will remain constant. So let us mark somewhere our original NPV. Let us mark it somewhere. Our NPV, our original NPV here. Can have it here, just a moment, so that we can work it out very clearly. Or we can do it separately. Yeah, we can do it separately actually. So let us do it like in this case. I need my NPV. I need my NPV when our cost is 11,000. What will I be having? All these factors will remain constant. So I'll be having 8,000 times 0.9174, right? Plus 9,000 times 0.8417. This time round, what is our cost? Our cost is 11,000 because it has been adversely affected. So minus 11,000. So what will be our new NPV? Our new NPV, I'll be having, this should give us, of course, 7339.2 plus 7575.3. I'm just taking these values because they are constant. They have not changed. Then I deduct now 11,000. So if I deduct 11,000, our NPV, if our cost is adversely affected by 10%, our new NPV will be 3,914.5. This will be our new NPV. So can we now determine the percentage change? How will we determine our percentage change? That will be easy, my good students, because I'll just be taking our new and old, then of course we divide by our old. So what will be our adverse change? What Mwalimu is saying that our adverse change here should be, adverse percentage change here should be as follows. I'll be having our new, or rather our new NPV, whatever that you're having, new NPV, minus our old NPV, we divide by our old NPV, of course, times 100, of course, times 100. That is what we are talking about, right? So having that case, that should give us what change? Our new NPV here. So this case, our new NPV, this space will not be enough, so let me work it out. So therefore, my percentage change here, I should be talking of our new NPV is 3914.5 minus our old NPV 4914.5. We divide by our old 4914.5 times 100, which should give us a percentage change of what? Minus 4914.5 divide by 4914.5 times 100. This should give us an adverse effect of 20.35%. That is what Mwalimu is getting, which you can confirm with what you are having. I'm having 20.35%. 20.35%. So you will find that the change, the adverse change of plant, cost of plant, will have an impact of reducing our NPV by 20.35%. Adversely, right? Adversely affecting our NPV by 20.35%. So we are done with the first variable, which was cost of plant. Let us conduct sensitivity analysis on the second variable, sensitivity analysis on the second variable. On the second variable, you realize that sensitivity analysis is more of like what if, right? What if? What was our second variable here? Let us see our question here. Our second variable. So we've done for cost of plant, running cost. Let us do for running cost, right? So in this case, I'll just write here what? Sensitivity analysis. We are looking for running cost, okay? We want to talk of running cost, How will we work it out? Our original running cost, we are having how much? Our original running cost, let us see. Our original running cost, how much are we having? Our original running cost, you can clearly see for year one. So I'm having here our running cost. Our running cost, year one, and we're having year two. So basically year one, what did we have for year one? Year one, we had, look at that case, 4,000. And year two, we had 5,000. Then that is enough for now. Let us see how it will affect us. So this will be adversely affected by 10%. So that is to say, I'll be having by 1.1 by 1.1. This should give us what? This should give us, my good students, I should be having 4,000 by 1.1 to give us basically 400. Year 2, 5,000 by 1.1. This should give us 5,500. That should be our new running cost with this adverse effect. So what will be our new cash flows? Our new cash flows, therefore, year one, I should be talking of, remember all these factors will remain constant. So the savings for year one, we had 12,000 minus 4,400. The savings for year two, we had 14,000 minus 5,500. Right? Believing that that is what you are given. If we can check this question of ours, that is what you are given. Look at that case. You see, the savings, we had 12,000 year one, and year two, 14,000. So once we have that in mind, this will be very easy. Determine our cash flows. Our cash flows, I should be having year one, 12,000 minus 4,400. This should give us 7,600. Year two, 14,000 minus 5,500. this should give us 8,500, right? So once we have that in mind, things will be very easy. Now we just determine our NPV while all factors remaining constant. So NPV, I should be having 7,600 times 0.9174. We add 8,500 times our factor, which was 0.8417. So we less our cost, which was our original cost of 10,000. All factors remaining constant, right? So what will be our new NPV? Our new NPV, I'll be having into bracket 7,600 times 0.9174 plus 8,500 times 0.8417. I less 10,000. So therefore, our new NPV here, with the adverse effect of running cost, I should be having 4126.69. Kindly, guys, you can confirm if you're getting the same figures. So once we have that in mind, things will be very easy here on our end, basically to determine what? Our percentage change. So what will be our percentage change here? Percentage change, in that case, we are looking at the adverse change. I should be having our new NPV, 4126.69, minus our old NPV, which was original, 4914.5. We divide by our old 4914.5 times 100. You see what I told you here? Adverse change, new NPV minus old NPV divided by old, right? So therefore, at this point, you can agree we should be having minus 4914.5 divided by 4914.5, right? So that should give us 16.03%. Mwalimu is getting, which you can confirm with yours, Mwalimu is getting here 16, adverse of 16.03%. So if at all we have changed our, if at all there is an adverse change in our running cost by 10%, therefore our NPV will be affected adversely by 16.03%. So this will be the impact to our NPV. I know just by that you can clearly and comfortably do the third sensitivity analysis, which our third sensitivity analysis here, third sensitivity analysis will be on what? We were asked on, this was on savings, right? I know now, my good students, you can do on savings. Should mwalimu leave it for us to try, or you can say that ni kazi ya mwalimu for him to clear? You'll say that ni kazi ya mwalimu for him to clear? Let us see. Let us work it out. So, what will be the impact here? What will be changing now basically are the revenues, right? Because the savings here, talk of our savings, year one savings, initially we had 12,000. Year two savings, we had 14,000. So if at all you are to talk of adversely affected, if at all you are to talk of being adversely affected, it means that our savings are reducing. This time round, it's not like cost. Remember, like adverse cost basically is an increase, but adverse savings basically it is reducing. So reducing by 10%. So that is to say my savings will reduce because it is adverse, will reduce by 10%. So it's 0.9 times 0.9, right? Our savings are reducing. and savings reducing basically, or rather adverse in that case, it is reducing. So I'll be having 12,000 by 0.9, which will give us 10,800, whereas here too 14,000 by 0.9, which will give us here 12,600. So basically this will be our new savings. This will be our new savings. This will be our new savings. So let me just have it, because I want to have it here in place, 10,800 and 12,600. So what will you be having? I should have our NPV. So therefore my NPV will be what here? Our NPV, therefore, I should be talking of 10,800. That is our new cash flow. This is not a new cash flow, but new savings. These are our savings, right? So we need to determine, even before NPV, determine your cash flows. So what will be our cash flows, my good students? Our cash flows, year one, I should be having 10,800 minus the original cost. Remember, all these factors are remaining constant. Original running cost, we had 4,000. Year two, I'm having 12,600. Original cost was 5,000. So what should we be having as our new cash flows? 10,800 minus 4,000 to give us 6,800. 12,600 minus 5,000, new cash flow should give us 7,600. So this will be our cash flows. This should be our cash flows. This should be our cash flows, 7,600, right? So once we have determined our cash flows, which in this case are 6,800 and 7,600. Once we have determined our cash flows, I know now to determine our NPV, it will be very, very easy, right? So what would be our NPV now, my good students? Our NPV, basically, I should be having our NPV to be 10,800, not but 6,800, 6,800 by 0.9174. We add 7,600. Remember, these are our cash flows, right? Times 0.8417. We less our original cost, which was 10 million. So therefore, what will be our new NPV if our savings was adversely affected by 10%? I should be having 6,800 by 0.9174. We add 7,600 by 0.8417. We less 10,000. This should give us our new NPV to be 2635.24. Our new NPV, right? So having our new NPV, what will be our adverse change? Adverse change, therefore, I should be talking of 2635.24. We less our original NPV, which we had it here still, 4914.5. We are going to divide by our old 4914.5 times 100. So what will be that change? What will be our change? Our change, of course, will be minus 4914.5 divide by 4914.5 times 100. Wow, that is a very huge impact. 46.38%. 46.38%. So look at this impact. So that is to say, in the event that our savings it is adversely affected by 10%, our NPV will be impacted by 46.38% adversely, meaning that it's going to reduce by 46.38%. So in this case, it is upon us now, looking at these three impact, looking at these 3 percentage, right? We're having these three here. So when we have conducted our sensitivity analysis, which one do you think has the greatest impact? Which one do you think has the greatest impact? We can clearly see here that it is sensitivity analysis, it is on the savings. If at all our savings reduced by 10%, or it is adversely affected by 10%, then savings is the most sensitive factor here. Savings is the most sensitive factor. Savings is the most sensitive factor in this case of ours, because you'll find that it has the highest impact. So in our analysis, of course, we are told to comment. We can say that savings is the most sensitive factor in the analysis of this project. Savings is the most sensitive factor in this analysis because it is the one with the highest impact, right? So basically, that is impact analysis. I've given you a clear way on how to understand the whole basic behind it, and also how to handle a question. In our next session, we are going to do another question for impact analysis, whereby I'm given, it is a very good question, which I believe you're going to join me in the next session to handle this other question for impact analysis. To that point, it is my prayer that you've learned, and let us meet in our next session. Thank you.